Thanks for clicking! The Canadian economy is starting to show some real signs of cracks, with Canada's unemployment rate coming in at 6.8% in November, the highest non-COVID unemployment Canada has seen in almost 8 years.
Doing a fantastic job.
Indeed, the worsening economic data has raised the chances of a jumbo rate cut coming from the Bank of Canada at its announcement on Wednesday, with the Bank of Montreal calling for a 50 basis point cut. And while we are no doubt going to hear a lot of predictions as to where the unemployment rate, the economy, and the housing market are heading given this escalating unemployment rate, I think it's worth taking a look at the last time Canada's unemployment rate was this high as a means of putting the current economy into context. So what I want to do today is go over Canada's unemployment data for the month of November, take a look at what the economy and the country looked like the last time the unemployment rate was this high, and then conclude by looking at some good news. The Bank of Canada's final policy announcement and press conference of the year is set for Wednesday, an occasion that will provide reporters with the opportunity to engage the governor in a substantive and mature dialogue. They won't do it, instead lobbing toothless, predictable softballs at the governor, but at least they will have the opportunity, and we will obviously cover that opportunity on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this unemployment rate. Out of the unemployment rate, as mentioned, Canada's unemployment in November came in at 6.8%, the highest non-COVID unemployment rate Canada has seen since January of 2017. And although that doesn't sound that great, it's actually a bit worse, as, looking back to 2017, the unemployment rate was actually on the downswing, moving down to 6.8. rather than being on the upswing, moving up to 6.8 as we have right now. In fact, back in 2017, the headlines were discussing Canada's job momentum and how we needed more immigration to continue to save the economy. Fast forward to now, and we're cutting immigration, with even current immigrants being worried about the economy, and 1 in 5 set to leave in the next 25 years.
Well, I should probably scoot.
And I bring up the newcomers as that's a big difference between right now and 2017, as back in 2017 the government was announcing its plans on bringing in a lot of newcomers, which, as even former Governor of the Bank of Canada Stephen Pallaz noted last week, those newcomers helped us to avoid a technical recession, as those newcomers buy the basics of life, boosting consumption. Desjardins said much the same thing last week, as have multiple business groups.
I need that money, that's all we got!
Yeah, when you have to consistently add new entrants or else the thing falls apart, there's a name for that.
It's called a Ponzi scheme. No, I haven't.
But that's different this time around, with the government announcing it would be cutting PR numbers from 500,000 to 395K next year, so we don't exactly have sky-high immigration numbers to artificially boost growth this time around. So yeah, back in 2017, the economy was on an upswing with unemployment dropping to 6.8. Things were looking up as we were getting more immigration to further boost demand. So much so, actually raised rates 6 months following that January 2017 read, which, suffice to say, absolutely no one is predicting an increase in interest rates over 2025.
That's a good thing, right?
And of course, as we've talked about before on this channel, when we say the Bank of Canada is going to cut interest rates, we mean the bank is trying to encourage Canadians to borrow and spend more to stimulate economic growth. So, how much more or less are Canadians able to borrow and spend than they were the last time Canada's unemployment was this high? Well, the good news, at first glance, is that back in 2017, Canadians were already being sarcastically applauded for their debt levels, with the Bank for International Settlements noting at the end of 2016, right before unemployment dropped to 6.8, that household debt to GDP had risen to over 100. But here is where the problem lies. That run-up in debt between 2015 and 2017 is what helped us to get to that downward trend in unemployment. In fact, in early 2017, after Canada's household debt to GDP had risen from 95 to 104, Canada's GDP growth was doing unexpectedly well, with household spending, that debt, being the dominant driver of that growth.
That is never going to change. Ever.
But fast forward to now, and it's not clear that we have that additional credit growth available for that additional stimulative spending, with household debt to GDP still sitting at 102, very close to its 2017 levels. Further, Canada also didn't have a mortgage renewal wave on the horizon in 2017, one which is expected to sap up available consumer spending this time around, with David Rosenberg back in June noting that consumer spending could drop by as much as 40%. Now, that was back when rates were higher, and we have seen a marginal drop in interest rates since then, but even Rosenberg noted in June that even a shock 1/4 of that size was enough to drive Canada into a recession. So, yeah, in early 2017, Canada had the loosening 2 years prior, and we had done the spending for those 2 years, leading to that 6.8% unemployment rate. Right now, we have that 6.8 unemployment rate, but consumer spending is set to increasingly drop heading into 2025. So, between the Canadian economy being on the downswing, cuts to immigration, higher debt loads than we had back then, as well as lower consumer spending going into the next few months and year ahead, right now is very, very different than 2017. And I suspect the government very much knows this. The government does not just introduce a whole host of new stimulus measures, cuts to the HST, $250 stimulus checks, and a loosening of mortgage restrictions for no reason.
Why?
Now, this is admittedly very dismal news, and I did promise some good news, and the good news is this too shall pass. BMO's Robert Kapchuk noted that although Canada is in for a reduction in consumer spending on the mortgage renewal wave in 2025, there will be less of that by 2026. And that matches the data that we pulled for other videos on this channel, showing that the height of the renewal wave is in early 2026. After that, we should see more money start to pour into the Canadian economy. Further, while some have thought the Bank of Canada was going to be pausing soon or even just cutting by 25 basis points in December, this new economic data now has the bank set to lower rates by 50 basis points at its next meeting. And so long as those tariffs from down south don't materialize, which I'll be very surprised if they actually do, then those lowering of interest rates will continue to put downward pressure on the Canadian dollar, which should result in a boom for exports, driving down the unemployment rate. Finally, it's not like every single piece of data that we're seeing is bad. We are seeing a modicum of an increase in consumer spending. Obviously not enough to curb the rise in unemployment, but people are still spending. So, all in all, comparisons to 2017 are not overly apt. Canada's economy was on the upswing. Back then, the unemployment rate was on its way down from previous highs, whereas this time, very, very not so much. But this too will be temporary. Economies run in cycles. Never, ever once throughout history has the party been able to go on forever.
Why?
Here is the US household to GDP since 2008, and here is ours. Here is the US unemployment rate, and here is ours.
This is your brain.
Though the US is also spending like it's already in a recession, so that's not exactly an overly apt comparison, but that's also a discussion for another time. So, all in all, the economy definitely not looking that great heading into 2025, and the risks are piling up. We have a rising unemployment rate, slowing immigration, as well as a potential slowdown in consumer spending, all set to be augmented in 2025. But as we saw, there is still some good news on the horizon, with that mortgage renewal wave set to die down by early 2026, and we should start to see an increase in consumer spending by then as well. And interest rates are coming down. How all of this plays out in 2025 remains to be seen, but we will obviously continue to track Canada's economy on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.